Ladies and gentlemen, we are diving down into the great Canadian housing market crash with some data recently released from the Toronto Real Estate Board that's going to give us some insight into Toronto real estate and the surrounding real estate area. We're going to be offering some insight from Canada's largest real estate investment trust, CEOs managing billions of dollars of real estate that offer some very insightful comments into the current economic circumstance. And we're also going to be taking a look at what I think is going on in the real estate market and what the short term and long term are going to look like and whether you should be buying real estate right now. And if that is a conversation you can appreciate, in return, I simply ask that you hit that like button, because taking a look at this data from the Toronto Real Estate Board, guys, this is representing the sales volume, home sales going on over this year. And we can see that in the gray box, that's 2019 data, the green box, 2020 data, the blue box, 2021, and the orange box representing this year. And we're seeing volume dry up by almost upwards of 50%. You might remember realtors saying, oh, the real estate market will never crash. We have a supply and demand problem. There's too many foreigners. There's just too much growth going on from a population standpoint. Little did they recognize that all those buyers would be shitting their pants right now as interest rates rise, values come down, and they're just like, forget it, I'm going to go to the rental market. And now we're seeing like 20% increases in rental prices, which is just wild. But take a look at the data of the actual value of home sales, because now we're back to 2021 levels, which if we take a look at the long chart, which better represents this, we are in a full-blown crash. Over February, we're seeing 20% corrections from like 1.2, 1.3 million housing prices to the average house now being somewhere between 8 and 900,000. And honestly, as inflation cools off, I wouldn't be surprised if the Canadian Treasury, the US Federal Reserve become a little more accommodative and stop jacking interest rates up so dramatically. But that's kind of what these buyers are waiting for the market to level out, interest rates to stop rising so dramatically, and we could start seeing that as a sign of a bottom. Now, I wouldn't be surprised in this overhyped market if we start seeing real estate correct somewhere between the $700,000 and $800,000 range. And again, I don't know if we get there or not, but I'm going to tell you why this is going to be a buying opportunity, probably of a lifetime, in a second, because there's some crazy metrics I heard from these big REIT earnings. Now, first and foremost, yes, it is very true that everybody has moved to the rental market. The rental market is the new housing market. You remember a year ago when everyone was just dying to get a for sold sign and own a property sight unseen, uninspected, and now all of a sudden those buyers are gone, and now you're competing to try and get a rental unit. And that has been driving up the rental market insane, which we saw from Canadian Apartment Properties REIT. This is Canada's largest REIT, and it is purely a residential and rental income REIT. So just taking a look at some of the earnings here, guys, we can see their operating revenue did increase pretty dramatically. And after listening to the earnings, the CEO said that they don't even want to make new acquisitions. They're primarily focused on just kind of turning over tenants and stabilizing and doing value adds to the properties they own, because they know the cash flow in a market like this is going to exponentially continue to increase as the rental prices continue to catch up to these crazy housing prices, right? Now, also with RioCan, this is another fascinating part of the Toronto real estate market I didn't know, because let's be real, Toronto, if you're trying to buy just even a plot of grass, you're probably going to be paying $1 million+. And RioCan CEO made a very interesting point, because this is primarily a mall REIT. And they said, look, there's no competition here anymore because nobody can afford to buy a plot of land, build a mall, and positively cash flow on it. So I find it absolutely fascinating that these large REITs, even from a retail perspective coming out of the pandemic, are still making record revenue, because anybody that wants to get into retail, they can only go to the few retail REITs that are currently providing leases, and there's demand for it. So they're increasing the actual prices to rent a place in a mall to sell your business, promote your products or whatever, right? However, because real estate's correcting, we're getting this catch-22, right? Where they have to do major write-downs against their properties, fair value adjustments, but the revenues are still going up. So I really like large REITs for generating cash flow. I think it's a little bit more securitized in the current market because they have kind of a monopolistic ownership over some of the most valued real estate in Toronto. So let's just take a quick look at a real estate deal in the current market environment, and then I'm going to explain to you why you still potentially may want to buy a home here, even if it's just a house you're living in, to get some equity value growth into the coming future. Because even though I think the markets are going to correct more, it needs to fall in line with cash flow that you can generate from rental income, because Toronto is primarily a growth market, which you can see within these numbers. So here's just a condo outside of Toronto, like maybe 30 minutes in Richmond Hill here. It's worth $638,000, 1,000 square feet. You know, you're getting a maintenance fee of about $670 a month. So let's see if we could actually buy this and rent it out and make positive cash flow. Obviously, the answer is no, but taking a look at a base mortgage, if you were to come up with a $238,000 $1,000 deposit. Let's say you had that much money, so you're only mortgaging $400,000 of this, which is again well over 20%. But nonetheless, here, folks, on a $400,000 mortgage left out on this property, I mean, at a 5.54% general interest rate coming out of Royal Bank here, you're left with a monthly mortgage payment of about $2,450. Now, slap on the fact that you're paying a $600 a month maintenance fee, slap on property taxes, probably another few thousand a year. Before you know it, you're paying probably somewhere between I'm going to say generally around $35,000 just for the base fees, insurance, all that stuff to own and maintain this kind of a property on a $400,000 mortgage. And the problem there in lines with the idea that the rental market is still, you're only going to achieve what, maybe $3,000, $3,500 a month at the most to rent this place out in the current market. And I've looked. So, I mean, you're not really cash flowing anything positively after a huge deposit is put down on a condo like this, because we are a growth market. We are not a rental friendly income based market. So I think what we're going to start seeing is the market coincide more with rental income as interest rates continue to rise in the midterm. Now, let me tell you why you'd still want to get into this market, even if you're buying a house to live in, because when you listen to these big real estate investment trusts, they kind of follow this sentiment that, look, it's impossible to buy new land around Toronto, develop, build rental units or malls. You'll never positively cash flow. So what does that mean, considering the supply and demand metrics are still here? They just shifted over to the rental market. And what does that mean if you're looking to buy a house in this kind of current environment? Because obviously in the long term, I really think Toronto is going to become the new New York. And the reason that is because we can't do development here. Our development sucks. This is all policy based, because what you're looking at is the green belt. The green belt is the limitations on development in protected lands. So my parents live up in cottage country on the southern tip of Lake Simcoe. They own a 63 acre farm. You have to have 65 acres to be allowed to even sever 1 acre for new development. So we can't build out huge subdivisions even this far north of Toronto, right? So that's what's been driving up the value of properties. We have all this immigration, all this population explosion, and now all those people coming in, they don't want to buy houses in this market, so they're going to the rental market. The rental prices are exploding, but inevitably they're going to come back as soon as the Fed becomes accommodative. The Canadian Treasury stops jacking them interest rates up, and all of a sudden, inflation cools off. All of a sudden, these people renting will see that the properties have devalued by 20-30+%, and rent's too expensive now. We might as well go back to buying. And that's going to cause a leveling off where we'll see real estate probably have an initial bump, and it'll probably start returning to a median of just generally going up year over year, or basically every 5-10 years you start seeing some really substantial increases unless policy changes. Until we can deal with this green belt and the policy for development and the cost of getting permitting, there's no reason that real estate in this current environment isn't a buying opportunity from a growth standpoint. Again, it is very hard to find positive cash flow properties anywhere around Toronto unless you're willing to go farther to the core of the lakes, maybe Barrie. You need to be really willing to extend somewhere where the real estate values and rental income are more at par, so you're able to cash flow maybe 3-6% after all the expenses are paid. Because right now, you'd be fighting to get the basic fees covered, which again, if you're looking for growth, you don't want to carry a property, maybe that's not the worst thing to do, right? Find a rental unit, maybe just make sure the numbers make sense enough to cover all the base fees, and just let the market do what the market's going to do, because inevitably I think it is going to come back. But in the meantime, you just need to be very careful about dealing with real estate if you're selling, because selling in a market like this is just vicious, like vicious. You just want to be a buyer. So if you have enough money to go put a deposit down on a house, hey, you can negotiate maybe now for $100K less. I'm literally seeing homes that were listed for $1.3 million just an odd 5-6 months ago, now selling for $800. That is a drastic difference in pricing. So don't give up on the real estate market, and just be aware that we are in one of the weirdest places on the entire planet. And if you can afford to buy a house, I'd always recommend, just getting your feet in and getting it over with, which is something I'm analyzing doing as well. But I'll pass the question off to you. I'd love to know what you guys think about all this in that comment section below. But stay cool, stay awesome, and as always, I look forward to catching you in the next one.